Everyone thinks they know Warren Buffett's secret. Buy great companies, hold onto them for decades, and let time do the rest. This is probably the most oft-repeated piece of investment advice in history. And yet, if that advice were really enough, there would be millions of Warren Buffetts today. After all, his books are public, his interviews are public, his portfolio is public, and yet, no one is replicating his performance. Why? What if I told you that the biggest lie about Warren Buffett was never told by Warren Buffett himself? The problem, it's not what he said, it's what everyone took away from it. And this confusion is probably costing investors billions of euros every year.
Today, it's easier than ever to follow Warren Buffett's lead. Every quarter, his portfolio is made public. Hundreds of YouTube channels analyze his every move. Thousands of articles explain exactly which companies he buys and why he buys them. Today, it's easier than ever to follow Warren Buffett's lead. Every quarter, his portfolio is made public. Hundreds of YouTube channels analyze his every move. Thousands of articles explain exactly which companies he buys and why he buys them. And that's exactly where everyone goes wrong. Investors think they're copying Warren Buffett, but in reality, they're only copying the final step of his reasoning. They're replicating his decisions without ever understanding the process that led to them. And that difference changes absolutely everything. Ask any investor what Warren Buffett's secret is, and you'll almost always hear the same answers. Buy extraordinary companies, hold on to them for decades, ignore market fluctuations, be patient. And the most unsettling thing is that all of these answers are true. But if these 4 principles were really enough, then millions of people should be achieving results similar to his. However, that's absolutely not what's happening, which means there's an essential piece missing from the puzzle. A piece that, surprisingly, is rarely discussed. In reality, people mostly remember Warren Buffett's decisions, but they almost never consider the context in which he made them. And that distinction is enormous, because the same investment can be a brilliant idea at one time and a very bad decision at another. To understand Buffett, you first have to understand the world in which Buffett began investing. Let's go back in time. No smartphones, no internet, no artificial intelligence, no YouTube channels analyzing every company. When Warren Buffett first started investing, finding a good company sometimes took days of research. Information was scarce, and whoever had it already had an advantage. Today, in a matter of seconds, millions of investors can view exactly the same figures. The world's top analysts, investment funds, algorithms, artificial intelligence. Everyone is watching the same companies. At the same time, this is where many people get it wrong. They think Warren Buffett simply found better companies. In reality, he operated in a market where good companies were often overlooked. Today, when an excellent company emerges, thousands of professional investors have already analyzed it before you even open your app. The game has changed. Here's the detail that most people overlook. Warren Buffett didn't buy a company just because it was exceptional. On the contrary, he might admire a company for years without ever buying a single share. Why? Because, in his view, an excellent company could still be a very bad investment. Buffett wasn't just looking for extraordinary companies. He was looking for the moment when the market was selling them at a price below their true value. That's what he calls the margin of safety. A simple idea, but an incredibly powerful one. Buy a company only when the price protects you from your mistakes. And that's precisely where most investors completely reverse their reasoning. They fall in love with a company, then they look for arguments to justify its price. Buffett did exactly the opposite. He started with the price, and only then did he decide whether the company was worth his money. It wasn't quality that guided his decisions. It was the gap between the price and the true value. Back when Warren Buffett was making his first investments, he wasn't competing with millions of other investors. He spent entire days reading financial reports that almost no one else looked at. Every overlooked company represented a potential opportunity. Today, that advantage has all but disappeared. Today, as soon as a company appears to be undervalued, thousands of analysts spot it almost instantly. Investment funds, algorithms, artificial intelligence, they all analyze the same data in a matter of seconds. What might have remained hidden for months sometimes remains hidden for only a few minutes. That's why the real advantage today is no longer just finding a good company. Almost anyone can do that. The real advantage is having the discipline to wait, even when everyone around you is already buying. Because in a market where information travels at the speed of light, patience has become much rarer than information. Let's try an experiment. Imagine that Warren Buffett were today, 25 years old, with 100,000 euros in savings. No billions, no reputation, no insider access, just a computer, and exactly the same market as we have. This raises a question. Would he really invest the same way he did in the 1960s? Many would immediately reply, of course. After all, good companies still exist, markets still exist, financial reports still exist, so why would he do anything differently? That is precisely where our intuition leads us astray. Warren Buffett was never famous for buying certain companies. He became famous because he knew how to adapt to his times. His real advantage, it wasn't a list of stocks. It was a way of thinking. And if Buffett were starting out today, he would likely focus less on replicating his past decisions and more on finding the kinds of opportunities that the modern market continues to overlook. For years, millions of investors have tried to copy Warren Buffett's portfolio. The same stocks, the same sectors, the same companies, but they were copying the result without ever copying the reasoning behind it. And that's probably the biggest mistake you can make in investing. Starting today, try replacing just one question. Instead of asking, would Warren Buffett buy this company? Ask yourself instead, at what price would Warren Buffett agree to buy it? This simple shift can completely transform the way you invest. Warren Buffett left us with much more than just a portfolio. He left us a way of thinking. Markets will change. Technologies will change. Companies will change. But one thing will always remain true. An extraordinary company becomes an extraordinary investment only when its price gives you a margin for error. And perhaps that is Warren Buffett's true secret.